Domino's was one of the greatest growth stories of the last 20 years. A stock that beat Amazon, beat Apple, beat almost every restaurant chain on the planet. But the numbers today tell a very different story. Same store sales are flattening, margins are tightening, and even Berkshire Hathaway, yes, Warren Buffett's firm, completely exited its Domino's position in early 2026. And when a stock goes from a PE of 39 down to 18 in just a few years, something has changed. Something has altered in the valuation of a company to bring those ratios and the prices down. Domino's built its empire on speed, consistency, and a franchise model that allowed it to scale faster than almost any restaurant chain in America. They weren't selling gourmet pizza, they were selling reliability, a system so efficient that it turned Domino's into a tech company disguised as a pizza chain. For years, it was unstoppable. But that momentum is starting to fade, and the slowdown is visible across almost every major metric. Let's talk about what's actually happened over the past 5 years. Delivery demand peaked in 2021. Labor shortages crushed delivery times. Domino's refused to join delivery apps like DoorDash and Uber Eats. That decision cost them millions of potential orders. International markets, once the rocket fuel of the business, suddenly hit a wall, and inflation pushed food and labor costs higher, squeezing franchisees who are already operating on thin margins. But the most symbolic moment came in 2025 when Domino's closed its final stores in Italy, the birthplace of pizza. Domino's spent years trying to crack the Italian market, and it simply didn't work. It's a small part of the business financially, but strategically, it shows that international expansion isn't the guaranteed growth engine it used to be. Now let's look at the numbers, because this is where the slowdown becomes undeniable. First, same store sales, which same store sales measure how much revenue existing locations generate compared to the previous period, usually year over year, excluding any new or closed stores. Now looking at Domino's, here is their US same store sales for the past 5 years. You can see how from 2021 to 2025, there has been slowdown in growth. Domino's used to post 5 to 10% same store growth. Today, it's stuck in the 1 to 3% range, barely above inflation. Now let's look at the international same store sales. You can see coming out of 2020, super huge growth after that COVID issue. International went from hyper growth to almost flat. That 8% to 0.1 collapse is the biggest red flag in the entire data set. Now, let's look at store openings from 2021 to 2025. Store openings, US stores grew from 6,500 to about 7,100, and then international stores grew from about 12,200 to just shy of 15,000. Domino's is still expanding, but each new store is producing less incremental growth than before. That's a classic late stage maturity problem. Now looking at margins from 2021 to 2025, corporate gross margin improved from 36.3% to 40%. But store level gross margin, the franchise margin, fell from 21.9 to 14.3%. That's a huge problem. Domino's is growing, but franchisees are making less money, and franchisee health is the backbone of the entire business model. When you look at their debt, long-term debt is still around 5 billion. Domino's isn't deleveraging its debt, it's staying relatively the same. And then you look at the valuation. In 2021, Domino's traded at about a PE of 39, priced like a hyper-growth tech company. Today, it's around 18. That's not just market volatility, that's the market admitting that Domino's growth story has changed. And then you have Berkshire Hathaway, right? They completely exited their Domino's position in Q1 of 2026. Buffett doesn't sell often, and when he does, it usually means long-term thesis has shifted. Berkshire started a position in Q4 of 2024 and added to it every quarter until removing it entirely of this year. To understand where Domino's might be going next, I ran a Monte Carlo simulation using their last 5 years of data. I then ranked that through 1 through 10 in each category for an overall score. Currently, the score is showing 63 out of 100. Again, this isn't financial advice. This is simply just a model I built to kind of run and see potentially where the stock price may go depending on random variables and different factors. Going through each score, revenue quality and growth trend, 6 out of 10. Margin strength and trajectory gave that a 5 out of 10. Margins are stable at the top, deteriorating at the bottom. Balance sheet strength is a 5 out of 10. Not dangerous, but not strong. Valuation versus growth is a 7 out of 10. Valuation finally makes sense. Competitive position, 7 out of 10. Management, quality, and capital allocation is a 6 out of 10. Earnings momentum, I would say 5 out of 10. And macro sensitivity, 7 out of 10, with sentiment and technical trend being a 5 out of 10, and cash flow engine strength being a 7 out of 10. So overall being a 63 out of 100. Now I have all my scores loaded in my Monte Carlo. We can see here we have Domino's stock indicator, the price, as well as the market cap. We're doing an initial investment of $1,000 with an annual investment of $1,000. Current dividend Domino's pays is $7.96, and on average, looks like they're increasing their dividends. We're going to do about by 10%. Here with this score of 60, we're going to run a few simulations and see what the scores come out to. So for the 1 year Monte Carlo simulation, we can see the median price of the stock came in at 322 with a max of 483 and a minimum price of 177. At the 3-year simulation, we can see that the median price was then 334, and then at the 5-year, we can see the median price was 349. So in the current Monte Carlo simulation, showing not a lot of growth, being, slightly some growth, but staying consistent. Not a lot of dividend, fluctuations, right? Some, fluctuations with the yield, but doing that 10% increase, no cuts there. If we then go on to the bull case and looking at the 1-year chart, showing the median price of being 328 with a max of 499 and a minimum of 193. At the 3-year, we can see the median of 357, max of 797, and a min of 12. And at the 5-year, we can see a max of 963, median of 389, and a minimum of 100. So some slight growth there, compared to the base case, but not a whole lot in these simulations. And then with the bear case, we can see the median being 322 after 1 year, the min 128, and the max 473. The median being 315 at the 3-year mark, and at the 5-year mark, the median being 302. So not a lot of movement with the stock. Kind of looking at the 3 years and the 5 years for the bear case, we do see that there was a dividend cut just based on those yield percentages at some point, and with what's getting paid out from a dividend perspective. So overall, the simulation doesn't predict collapse. It predicts a company transitioning from hypergrowth to maturity. Domino's is still a phenomenal operator. It's still a cash machine. It has one of the strongest franchise models in the restaurant industry, but the numbers don't lie. Growth has slowed, margins are tighter, international expansion is less reliable, and even Berkshire Hathaway has moved on. The era of effortless growth is basically over. The next chapter depends on delivery, app adoption, cost control, whether Domino's can reignite international momentum. Domino's isn't broken, it's just finally acting like a mature company. Their earnings are this Monday. Let me know what you think will happen when they report out earnings. Thank you for watching. Please like and subscribe. Again, not giving financial advice. These are just simulations I'm running with, my own analysis based on where the stock is going. Not recommending that you buy or sell the stock. Please do your own financial research and consult your own financial advisor before making your own financial decisions. Thank you and have a great day.